Good morning everyone, this is Charalambos Pissouros, Senior Analyst at IronFX, bringing you the morning comment for the 25th of January. The Canadian dollar jumps as Trump clears the way to build oil pipelines. The Canadian dollar surged against its major counterparts yesterday after US President Trump signed executive orders to advance the building of the Dakota Access and Keystone XL oil pipelines, a move that had been previously blocked by the Obama administration on environmental concerns. The Keystone XL pipeline of the Trans-Canada Corporation, if finalized, is expected to carry Canadian oil from Alberta to US directly, which could increase efficiency and thereby drive down costs of delivery. Something like that could result in increased profits for oil companies and improved terms of trade for Canada in the future. Even though President Trump signed an order to clear the path for this to happen, it is only a preliminary move that simply allows the Trans-Canada Corporation to reapply for a permit to build the Keystone pipeline. The application will be reviewed by the US State Department, which will announce its decision within 2 months. This implies that if and when the application is formally approved, we could see another positive reaction in the loonie. Dollar CAD fell back below the upside support line taken from back at the low of the 3rd of May yesterday to hit support near the key zone of 131. Then the rate rebounded somewhat to find resistance at 131.70. If the bears are strong enough to take charge again, we would expect them to aim for another test at 131, where a clear dip is possible to open the way for the next key obstacle of 130.30. However, with regards to the broader outlook, although the rate is back below the uptrend line taken from the low of the 3rd of May, we maintain our flat stance. A clear break below the psychological zone of 130 is the move that could make us more confident on larger bearish extensions. Market attention is likely to remain on the executive orders that President Trump is due to sign, as they do not require congressional approval and can be enacted immediately. The press suggests that the next items on his list is immigration and the wall on the Mexican border. If he indeed signs an executive order that lays out a plan for building the wall, the Mexican peso could come under renewed selling interest. Overnight, the Australian dollar slipped during the Asian morning Wednesday after data showed that the nation's CPI rate rose by less than expected, while the trimmed mean CPI rate ticked down. Despite missing their estimates, both prints are roughly in line with the RBA's forecasts, and as such we don't think that these figures will trigger an immediate policy response from the bank. Having said that, the risks for a rate cut in the coming months have increased somewhat, a factor that could put a lid on any further Aussie gains in the near term. Aussie dollar slid on the news, breaking below the support now turned into resistance barrier of 0.7555. The price structure on the 4-hour chart still suggests a short-term uptrend, but we see alarming signals that the trend is running out of fuel. Such evidence are derived from our short-term oscillators. The RSI dipped below its 50 line, while the MACD, although positive, fell back below its trigger line and points south. Moreover, there is a negative divergence between both of these momentum studies and the price action. A decisive dip below 0.7520 would confirm our concerns and is possible to set the stage for extensions towards our next support zone of 0.7465. As for today, during the European day, Germany's HIFO survey for January is due to be released. The forecast is for both the current conditions and the expectations indices to have ticked up. Although this may not prove a major market mover for the euro, given that the single currency has not been responding much to neither the HIFO or the ZEW surveys lately, we believe that further increase in the HIFO prints could support the DAX index somewhat. Later in the day, during the Asian morning Thursday, we get New Zealand's CPI data for the 4th quarter. The forecast is for the CPI rate to have skyrocketed to 1.2% year over year from 0.4% in the 3rd quarter. Such a jump may have been fueled by the RBNZ's 3 rate cuts throughout 2016, as well as a rapidly tightening labor market. A strong CPI print is likely to deter the RBNZ from introducing any more stimulus in the foreseeable future and thereby bring the Kiwi under renewed buying interest. We have two speakers scheduled for today, Bank of England Governor Mark Carney and Riksbank Governor Stefan Ingves. For more information, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX, wishing you solid trading.